So today we're digging into an essential end of the year financial planning topic that if this applies to you and you don't follow the IRS rules, it can cost you a ton of money in penalties. And this is called the required minimum distribution rule. I will explain how this rule works, give you actual examples, and at the end of the video, share strategies on how you can reduce your tax burden on your RMDs, because believe it or not, some folks who have a lot of wealth in tax-deferred retirement accounts can end up paying more taxes in their retirement years without proper tax planning done in advance. So here we go. So the required minimum distribution rule states that for most retirement accounts, when you reach the age of 72, you must take out a minimum dollar amount from your retirement account. If you don't take your required distribution before December 31st of that year, you pay a 50% penalty on the amount that wasn't withdrawn. So if your required minimum distribution is for $10,000 and you don't pay it before December 31st, that's a $5,000 penalty you pay in addition to the tax owed on the $10,000. That's a huge penalty. Now, you may be asking yourself, who is the IRS to tell me I have to take money out of my IRA? Oh, and by the way, you pay taxes on the amount too because it's counted as income. I've had clients say, I don't want to do this. I don't need the money in my retirement account to live on. Well, that's the exact reason they have this rule. The IRS wants to get paid. IRAs, 401ks, SEPs, these are all tax-deferred accounts, and the IRS says when you turn 72, you've pushed off not paying taxes on that money long enough, it's time to take some out. To illustrate an example, if you have a $300,000 retirement account in a prior 401k, traditional IRA, SEP IRA, and you're age 73, you'd have to take out close to $12,000. If you fail to take that out as a distribution, you pay $6,000 a penalty on top of the normal ordinary income tax on the $12,000. Remember, any money taken out of a tax-deferred retirement account is taxed as income when distributed and will be subject to whatever tax bracket you're in when you take it. So if you're a business owner doing really well, your tax bracket can easily get into the 30% range, especially if you're married. So if this rule applies to you, please don't forget to take your RMD. The retirement account types that the required distribution rule applies to are the traditional IRAs, SEP IRAs, simple IRAs, 401ks, profit-sharing plans, and 403b plans. So if you have multiple IRAs or 401ks from prior employers, each of those individual accounts have a required minimum distribution amount that you need to take out by year end when you reach age 72. Now, a quick note, in the year you turn 72, you can delay your first required minimum distribution until April 1st of the following year. Just understand that if you delay taking your first distribution to the following year, you'll need to take 2 distributions. Here's what I mean. If you turn 72 in August of 2023, you can technically delay your first distribution until April 1st of 2024. Now, I caution when people do this because that means for 2024, you'll need to take 2 distributions. One for 2023 and one for 2024. You can't keep delaying when you take your distributions. And if one distribution, as an example, is $12,000 and the other is for another $12,000, that's $24,000 in income that you will owe tax on. And without proper planning, that could potentially bump folks into another tax bracket, forcing you to pay more taxes on your money. Now, a popular type of account that is not subject to the RMD rule and that I'm really a fan of is called the Roth IRA, because in a Roth, there are no RMDs. Now, what if you're still working and participate in your employer plan? Do you have to take a distribution from your current employer 401k if you are age 72 or older? And the answer is no if you are an employee. However, if you have a Roth 401k and you're 72, then yes, you do have to take an RMD for 2023. Starting in 2024, a Roth 401k will not have RMDs anymore. If you have other IRAs or prior 401ks, then yes, you need to take an RMD from each of those accounts, but not your current 401k held at your current employer. If you wanted to avoid taking the RMDs on those outside IRAs, you could simply consolidate those into your current employer 401k plan if it allows it. So as an example, if you had a $300,000 IRA, you could potentially transfer that into your current 401k plan at the company you're working at, and then not be subject to the RMD rule on the IRA because it's now in your 401k plan. Now, if you are a business owner, there is another layer of complexity here when it comes to the RMD exceptions. If you own more than 5% of the business, the still working exception will not work for you. If you own 5% or less of the business, you can delay the RMDs until you retire. So if you own more than 5% of the business, you'll need to take a RMD from your current retirement plan that you have set up within your business, even if you are still contributing to it. So the 401k, SEP IRA, Simple Plan, Profit Sharing Plan, these are all common plans owners can put in place for themselves and could be subject to this rule. Now, why is this important for business owners? 40% of small business owners are baby boomers, which include many owners who are either approaching or over the age of 72. And many have no intention of retiring from their business. Tax issues really start to come up when you build a 7-figure retirement account. For example, if you are 73 and have $1 million in a retirement account, your RMD would be around $39,000. On a $2 million account, your RMD would be over $78,000. Not only are the penalties outrageous if you don't take these, but those distributions are counted as income, which means it can push you into a higher tax bracket. It can affect your Social Security and make that also taxable. If you show too much income and you're on Medicare, your Part B and Part D premiums can be increased. So large RMD amounts can potentially spill over and add additional taxes in these situations. How to reduce your taxes in retirement on RMDs? Let's go over those. The first strategy is doing Roth Conversions, meaning you move money from your tax-deferred retirement account into a Roth account, essentially paying the taxes early and hopefully during your lower income years rather than waiting. There's a lot of nuance doing this strategy. I'd highly recommend speaking to a professional first. The second strategy is making a qualified charitable distribution. You have to be age 70 and a half or higher to do this, but this strategy allows you to transfer your required distribution directly to a qualified charitable organization. The entire distribution will not be taxed, and you can donate up to $100,000 per year. Note, this only works for you if you don't need the money in the retirement account to live on, because you're giving the entire distribution to a charity. The third strategy is you can work longer if that's what you want to do. If you have prior 401ks or IRAs, you could potentially avoid having to take RMDs on those outside accounts by transferring them into your current 401k plan. If you're an employee and still working, even though you are over the age of 72, you wouldn't be required to take an RMD from those accounts. The key to planning for the RMDs is getting something done in advance. The longer you wait, planning options become limited. I hope that's helpful. Thank you for listening. Please subscribe, and I will see you in the next video.